Seatbelt yourself in, Mr. Jerry Holland, because we have started. Hello, Vetted VA community. My name is Helmer. I come to you each and every week with your mortgage market update, letting you all know what's going on with the mortgage market with interest rates and all that kind of stuff. Today is September 20th, 2023, just for a reference point, and I'm joined with today's guest, Jerry Holland. Thank you, Jerry, for joining us, and please take literally 30 seconds and just tell everybody a little bit about yourself.
So I'm Jerry Holland. I'm originally from Oklahoma. I've been with a Vetted VA for about, I think it's 3 years now. It's crazy how time flies, right? And I was just looking at the stats on Vetted VA yesterday, and it seems like last time I looked at it, we had 60,000 members. And I want to say now we're closer to like 71, 72,000 in just a blink of an eye. So love the community, love the veterans, and love seeing everything that we're doing as far as education goes.
Well, thank you for joining us today, my friend. And if you guys are here live, I know that most of you are very busy, but if you are here live, let us know. And if you have any questions or comments, feel free to post those in the comment section. I do monitor that as we're going through here. If you're watching on the replay, do us a favor, just put hashtag replay in the comments. It helps us to know that you guys are watching. We've got all the Facebook analytics and YouTube analytics, but it lets us know that you guys are watching as well. And we do monitor the posts. So if y'all have questions, you can tag Jerry Holland, you can tag Helmer, and we will make sure that we answer those. We do see a lot of people that come back in and put comments in afterwards. So go ahead and do that. And with that part out of the way, let's go ahead and talk about rates. Remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. So when it comes to rates, always make sure you're shopping around, make sure you're comfortable with who you're working with. But we just want to give you some insight into where things are and where they're going these days and all that good stuff. So a quick recap. What has happened since last week? Well, really not much. Rates have been, pretty stable. We do see mortgage rates go up and down every day. And sometimes the rate itself will stay the same, but the rebate pricing would change up. Jerry, can you explain to everybody what is rebate pricing, or what would they, in their world, what would they see if we say, well, rates have been the same, but the pricing changed?
I don't know if I know what rebate pricing is, right? I would imagine that you're talking about the secondary markets and stuff. Is that where you're driving?
I'm talking about it. So if I quote you a rate today of say 6 3/4, but it's going to cost you $200, and then the next day I might say, hey Jerry, we're still at 6 3/4, but today it's going to cost you $400. Because that's the pricing, the rebate pricing that can change
the points
sometimes.
And the
points,
yeah,
exactly.
Yeah. So we get that, and so I like to describe it like, hey, we got the market rate right here. They'll say 6 3/4, right? And throughout the day, the market is going to move up and down. And so if it moves higher than this rate, you're going to have to to get the lower rate, you will have to pay a little bit extra to get there. So $200, $300, whatever. If it moves below that market rate, and we're still giving you a 6 3/4. Well, now we're going to give you a lender credit to come in there.
Yeah.
And so that's kind of what I look forward to when I'm explaining that stuff. Break it down.
Exactly. Yeah. And that's what makes, back in my day, I sound so as old as I feel these days. There was a time where we just gave an interest rate and we didn't have to worry so much about that. And there were people could buy down the rate by paying points and get a little bit of a better interest rate. But if the rates moved on the back end in the market side, the bank and the lender and the originator even would either make a few extra bucks or lose a few bucks, but we didn't have to disclose all that to the consumer. That changed in 2010, and it became such a pain because people are like, wait a minute, so I still get 6 3/4, right? And you're like, yes, but it's going to cost you $400. And they're like, but no, yesterday you told me I got 6 3/4 and you were going to give me $400. And we're like, yeah, that kind of changed. And they're like, wait. And you go, tomorrow it's going to change again. And it could change this afternoon.
So it could change in 2 hours.
I mean, it could change.
Let's get real, right?
It could change. And then we'll tell you guys why rates change in a minute. So let me put the slides back up, though, and we'll keep on here. Rates, though, are pretty stable, meaning you're going to see rates that are very much, they go up or down, usually maybe 1/8 of a point. You'll see some differences, small differences in what you have to pay or the credit that you're getting for that rate. VA rates are averaging the high 6s to low 7s on average. Does that sound right, Jerry, in your market and in the Oklahoma market for you and your clients? Do you find that VA rates are generally in the high 6s or maybe low 7s right now?
So that sounds like spot on for us. And actually, I'm not in the Oklahoma market. I was there.
Okay.
Florida and Utah.
Oh, Florida and Utah. Okay.
Yeah.
And then conventional rates are averaging in the low to mid sevens. And a conventional loan is a loan for somebody that doesn't have a VA entitlement and can't use VA benefit and get a VA mortgage. They're going to get a loan that's generally through Freddie Mae, Fannie Mac. We call those conventional loans, just your normal everyday mortgage. And those rates are a little bit higher. You do tend to get better rates as a VA borrower. So conventional rates are averaging the low to mid sevens. Sometimes they can be in the high sevens, especially there's different variables that are going to affect your mortgage rate, such as your credit score, the amount of money down. And in fact, there were some weird changes made I want to say maybe even close to a year ago at this point, where if you put more money down, the rate can actually get slightly worse. People are like, that makes no sense. That's the mortgage business, folks. Welcome to our world. I could tell you why it makes sense, but no, it doesn't make sense. Now, let's talk about what's going on, though, and let's tell you where rates are headed. Today is a big day. Today is one of the Fed meetings. The Fed meets, I think it's 8 or 9 times a year, and they're going to meet today. They started meeting yesterday. They're going to conclude their meeting today in about 2 hours, and the Fed is going to release a policy statement at 2 p.m. Eastern time. As part of that policy statement, they're going to talk about if they're going to raise the Fed funds rate, which is the Fed's policy rate. The Fed does not directly control mortgage rates. They don't set mortgage rates, but they definitely influence mortgage rates. So when I talk about the policy statement coming out, they're going to come out and say how they view the economy, how they think that the markets are doing, how rates are doing, and how inflation is doing. And the Fed has been fighting inflation now for over a year, and they've done that by raising rates. And that's why we saw rates that have moved from, we'll call it the 3s into the 7s. And this meeting, they are likely to pause their rate hikes. So the Fed has been raising rates since March of 2022. They raised rates at almost every meeting. In the June meeting, they paused and then decided to raise rates again in July. And then now we're in the September meeting, and it's expected that once again that they are going to pause. And when I say that it's expected about that, what we look at is we look at what are called Fed futures. And this tells us what are the markets betting on. Right now, the markets are betting that it's a 99% probability that the Fed will maintain that 5.25 Fed funds rate. 99% is pretty strong. That's a pretty strong idea. However, we could see the things move around a little bit because the Fed's going to come out with what's called a dot plot. And that's this fancy thing here. I'm going to show you guys a little bit more about this and tell you why we read this and why that matters and that kind of a thing. So we'll come back to that one, but we're going to see the dot plot at 2 p.m. Then at 2:30, Fed Chair Jerome Powell comes out and holds a press conference. And he's in a room with a bunch of reporters. They're going to ask him a bunch of oftentimes silly questions. And markets are going to react to what Fed Powell says and what Jerome Powell says. And at 2:30, they come out with that. It lasts you generally about 45 minutes to an hour. And we often, this is the key for you guys, for everybody watching, we often see rates get volatile in the afternoon, meaning like what Jerry and I were just talking about, you may see rates that the quote you got this morning, maybe Jerry quoted me 6.75 and he was going to give me $400. Well, this afternoon, 6.75, I may have to give him $400. That could go one way, or it could go the other way. And Jerry says, hey, Hammer, things are looking great. And instead of getting you 400, I can get you 800. So we're going to see some volatility this afternoon. That really only affects you if you're under contract and you have not yet locked in your interest rate. So if you have found a home, or if you're in the middle of a refinance transaction and you are right in the thick of it and you have not locked in an interest rate, that's where you're going to be paying attention to this. If you're out there house hunting or you're considering refinancing, well, this is going to happen and you're going to have no control over it. And it's just going to be part of where we're at, so you don't have to worry too much about it, but you want to keep track of it. As far as forecasting, everyone always says, Hammer, where are rates going to go from here? Rates are likely, in my opinion, and this is just, again, this and I don't know, $3 these days will get you a cup of coffee, right? So rates, in my opinion, are going to creep up a little bit over the coming weeks. And I'll show you guys why in a minute, or why I think so at least. But they're not going to really go up too much more from here. They're probably only going to reach the worst levels that we've already seen in 2023. And that's about 0.25% higher than where we're at today. And that's kind of I'm going to call that our bad case scenario. Our worst case scenario would be they just keep going, right? But we're going to call that our bad case scenario. They could get a little bit better, and I'll tell you some variables we're looking at, where we're going to listen for during that Fed meeting this afternoon in a couple of hours that could actually drive rates to improve a little bit. But rates are really going to continue to stay in the range that we've grown used to. And when I say a range, I mean that they're always moving. They go up, they go down, they go up, they go down. Generally, it's about 0.5% that we've grown used to. So on a VA rate, that may be as low as maybe say the low sixes, 6.25, and then on the higher side at 6.75. We may see rates that fluctuate between that range, and that's likely what we're going to continue to see. So I think over the next couple of weeks, rates are going to creep up a bit, but I think that once we get past those next 15 days, I think that we're going to see rates very much stay in the range that we've grown used to. I think we don't have to worry about rates continuing to move higher from here, is my point. I think we're close to the end of that, and that rates are not going to move lower, which we all want them to move lower, but they're not. There's no reason for them to move lower until we see some economic conditions change. And I don't think that's going to happen until we get into 2024 at least. I think we've got at least another 6 months before we see rates that are in a position to come down. So that's my forecast. Jerry, what would you add or question, or what's your take on any of that?
First off, $3 coffee. I think that's amazing. I got to start going there, right? But no, I think you're spot on with where we've seen a trajectory where rates have just slowly been rising over time, right? And I don't really see any immediate indication saying that that's going to change. And so 15 days, see rates rise up because of volatility, and then watching let the investors sort of digest what the Jerome Powell puts out in the Fed comments. And I think you're spot on. I think we're going to be rolling into 2024 before we really see big opportunity for refinances or any of that coming down.
And then I'm going to throw up my Remarkable real quick here and see if it wants to cooperate. And I'll put this on the screen for y'all and explain to you why we're seeing some of that. So the question that's on the screen, someone said, do I think that locking before the meeting is wise? And the answer to that is no. I don't think before the meeting. This is, go ahead, Jerry. You can answer, and then I'll come back to it. You sound like you've got an answer for that, so go ahead.
So I've actually advised my guys. I was like, hey, we're heading into a day of volatility where we see trajectory going up. And so I told some of my guys, if you got something that needs to be locked, lock it today. And this was yesterday, right? I was like, lock it today, get it taken care of before we roll into that volatile market where we have the unknown. Anytime you roll in something unknown, you run the risk.
Yeah, and that's a great question. So normally what happens, a lot of the economic events that affect mortgage rates, they happen at about 8:30 a.m. Eastern time, by the way. This is always Eastern time. So we get reports that come in like inflation, different inflation data. We get different jobs data. And they all come in early in the morning. Now, most lenders, they're going to set their pricing at a window between 10 and 10:30 a.m. Eastern time. Okay. That's when most lenders, they set their pricing on the day. When I say set their pricing, I know that this gets a little complicated, but I'll show you guys some of the pretty stuff here. When we say that they set their pricing, what they're doing is they're looking at how the market is performing. Specifically, as I've covered in the past, they're looking at mortgage-backed securities. So right now, our mortgage-backed security market, the particular coupon I'm watching, is up 14 basis points. A basis point is 1/100%. And, again, I'm throwing a lot of jargon at you, but the fact that this is green and positive is good for your mortgage rates is the bottom line. If this were down, if this were red and minus, that would mean that rates are probably going to be a little bit worse today. And the rate may be the same, but that plus or minus that we talked about that you may get as a credit or it may cost you to get that rate may change. Now, let me see if I've got, all right, cool. So what happens is lenders are generally, they're going to look at this window between 10 and 10:30 a.m. And that's when they start to set their pricing. So they look at the market. And the reason they're looking at the market is that they're going to be taking the mortgages that someone like Jerry does, he's your contact, he's your mortgage originator, he's your professional. He's going to help you to get that loan closed. They're going to take that loan and they're going to sell it on the secondary market. And we won't go too deep on that today. It'll take a little bit longer. But because of that, that's where they come out with that pricing. Now, they're going to come out with pricing at 10 or 10:30. Today, when the Fed meets, we actually have two different times that are important. So we have 2 p.m. Eastern, and again, all these times are always Eastern time, and 2:30 p.m., which really, I'm going to say this is actually about 2:50 to 3 p.m. is when I usually see the most movement. So what happens is there's two events coming out today. At 2 o'clock, the Fed is going to come out and they're going to release their policy statement. So they're going to come out with a long-winded thing that says, we're watching the economy. We've seen this, that, the other thing. Markets or traders are going to pour over that actual statement, looking for what is the Fed going to do in the future. Everybody wants to know, what is the Fed going to do in the future? And that's what they're always thinking about is what is the Fed going to do in the future? Oh, that's why. Okay, so there we are. All right. So when we see that, that's where this chart comes in. So right now, the expectation is about 70% of the market, based on where they're putting their money where their mouth is. They believe the Fed is going to keep the rate in November at the next meeting at 5.25. They believe that December, we're going to see the Fed possibly start to raise rates and maybe go to 5.5. That's a 35% probability. That's what's currently anticipated. Mortgage rates react today to the expectation of what's going to happen months from now. So we're not going to see mortgage rates move when the Fed makes these moves. We're going to see mortgage rates move as markets become more secure in the idea that it's going to happen, and markets are reacting early. So we're looking all the way through 2024, and that's where that dot plot comes in. So today, the Fed is also going to release this information here. Now, this is actually two dot plots in one. We've got the light blue, which is March, and the dark blue or purple, which is June. So every 3 months, the Fed comes out with a new dot plot. And what a dot plot is, each of these dots is an anonymous Fed member. And I think there's 18 of them if we count them up. They're going to go out there and say, okay, this is where we think rates are going to end 2023. This is where we think rates are going to end 2024. This is where we think rates are going to end 2025. And for the longer run, this is where we think our Fed funds rate's going to be. And again, this rate that we're talking about is the Fed funds rate. It's not mortgage rates. This is the Fed funds rate. And it trickles through and affects everything else in the economy. So what happens in March, we had kind of the consensus was that rates would be at about 5%. There was a little bit that believed they'd be higher, anywhere from 5.5% to 5.75%. Well, June, everybody said, you know what? We think that instead of being at 5%, we're actually going to need to bring that rate up to 5.5%. And the reason they're raising the rate, again, is to slow the economy down, fight inflation, get the job market under control. They want to have a really strong jobs market, but they don't want it to be too strong. They want it to be unemployment to be low, but they want it to be where, the number of people looking for jobs and the number of jobs created are similar. They want it to be a healthy, not where there's too much one way or the other. Same thing for the economy. And they want to get inflation under control. And again, that's going to happen with supply and demand by slowing down the economy. So they're going to release another dot plot. Now, if the Fed comes out with an overwhelming, again, if more people, more Fed members believe that we're going to want to be at that 5.5 or maybe even higher, which is unlikely, then markets are going to be like, okay, well, maybe the Fed is going to raise rates. We're going to see these numbers here change. And if these get worse, if the market starts to believe the Fed will raise rates again, mortgage rates are going to get a little bit worse. And it will generally be about 0.25%. That would be why I think rates are going to move higher. I think markets are going to believe that the Fed is going to continue to raise rates and at least one more time. And then the next thing they'll be looking for is, when are the signs that the Fed will actually cut rates again? So the Fed is going to hold these rates as the economy slows down. Imagine keeping your foot on the brake of the car. When are they going to take their foot off the brake? When are they going to put their foot back on the gas? And when, that way, the way that they put their foot back on the gas is by lowering rates. They take their foot off the brake by pausing rates, pushing the brake pedal, to slow the economy down, raising rates. So that's kind of what everyone is looking at today and based on that movement. And what we tend to see is we're going to see these fancy charts. They're going to start going crazy this afternoon. They're going to go up. They're going to go down. And mortgage lenders are actually going to say, okay, time out. We've got new pricing. Remember that rate quote I gave you this morning? It's no good anymore. Now it's this. And if they think that the Fed is going to be what we call dovish, meaning more accommodative, maybe not raise rates, maybe cut rates sooner, markets are going to react and say, okay, things have actually improved. You'll see slightly better mortgage rates. What I think is going to happen is we're going to see more of a hawkish tone. The Fed is going to say, hey, they're like stern parents. They have to be like, we're not ready to see this yet. We're not done yet. We may still have to. We're data dependent, blah, blah, blah. And I think markets are going to kind of like, they're going to go up, they're going to go down, they're going to go up, they're going to go down. But overall, I think we're going to actually kind of level off. And then what we've seen after the previous meetings, if we look at the other meeting dates, we look at July's meeting was July 25th and 26th. And what happened is that back on the 25th or 26th, that's right about here. So as you guys see these candlesticks go lower, that means mortgage rates get worse. As they go higher, it means mortgage rates get better. So after the last meeting, it was kind of, stagnant for a few days, and then we got slightly worse, a little bit better, and then a lot worse. If we go back a meeting before that, was the June 13th and 14th meeting. And that one was the last time that they paused, like what's expected to happen this time around. And if we look at that June 13th or 14th meeting, again, we're up here. It kind of kept going, sideways for a few days. And then about 2 weeks after that, boom, it went much lower and rates jumped. I think we're going to see a very similar pattern this time. But again, that's just my opinion. Why I think that's going to happen is because I think the Fed is still going to be very hawkish, meaning that they know they're still fighting inflation. They know they have to keep their foot on the brake pedal. And I think that that's what we're going to see reflected in the market. So with all of that said, let me turn it back over. Mr. Holland, is there anything you would add to that?
No, I just agree with you 100%. I do like that you kind of jumped in and explained the dot graph matrix. I've always seen that. I've always followed that, but I've never had it explained out, right? Quite like that.
Awesome.
And then
yeah,
the percentage of it.
Yeah, and that's why, and basically each member is anonymously saying this is where I think rates are going to be, and markets will look at that, and they're basically daring the Fed. So the Fed this dot plot is going to say that rates are going to need to be raised. I feel very strongly. I think it's what we're going to see today. But the markets are going to look at it and go, you kind of have to tell us that. Because if the Fed were to turn around and say, okay, we're done raising rates and we think things are good, what happens is if they do raise rates later next month or in December, it's going to shake up the markets. It can be very bad for stocks and bonds. And the Fed doesn't like to shake the markets. They like to kind of, catch early what they're doing and kind of lead everybody on. That's kind of the relationship that they have. And so if the Fed were to actually say, well, we think we're done and we're going to show our hand, they're concerned that markets will be like, okay, this is great. All of these higher rates, we're going to start to see these go back the other way. Let's get out there and do more business. Well, it's going to heat up the economy, which is going to add to more inflation. The Fed's going to have to then be more restrictive, so it can create this negative environment, and they don't want to do that. So it's a little complicated. Hopefully we were able to break it down so that everybody at least gets a handle around why this stuff's so important, how it could play out. And, again, you don't need to know the ins and the outs. You don't need to be an economist to go deep on this stuff. When the Fed raises rates, mortgage rates are going to follow at one point or another. It's just, when they start to lower rates, we'll see mortgage rates go down. And we'll probably see mortgage rates react early. It's kind of like when the kids are, in the closet looking for their Christmas presents. Just my own funny analogy. So
it's
awesome.
A great one, right?
So, well, Mr. Holland, we always do try to keep these short. I think we're good here. Is there anything that you would leave everybody with?
No, I just say, like you were saying, they keep things predictable. If you can keep it predictable, keep the unknowns at bay, then you're going to have a much better experience going through the home loan process. And so that's my advice.
Thank you, Mr. Bill Stevens, for being on with us and providing comments. Appreciate that. Remember, everybody, we do this each week. I will be here next week, so you'll see me at, we got 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And if you have any questions, feel free to put them on this post. You could tag Jerry Holland or you could tag Helmer, and we'll do our best to make sure they're answered for you. Thanks again, Jerry, for joining us. Take care, everybody.
Yep. We'll see ya.